Good morning and welcome back to Almus Market Mornings. We are closer to the highlight event of the week, and that's the Federal Reserve's interest rate decision. While the expected move is of a rate cut, there are a lot of intricacies involved. Recall the journey in the previous meeting, there were two dissents, one to lower rates faster, while one to keep rates steady. Even with the dot plot, it was evident that the voting members within the Fed are having diverging views. And subsequently, the speeches by various members of the Fed has also highlighted this divergence sharply, which I feel makes the December decision even trickier and maybe not even a slam dunk rate cut. Good morning, JK. While we are aware markets are pricing a 25 basis point rate cut tonight, and that's the higher probability event that might happen. Do you feel there is even a small amount of risk that Fed might not cut today at all?
Good morning, Swaraj. No, I don't think so. I think they will follow, or rather, they will be cutting rate at 0.25%, which is what the market is also overwhelmingly discounting. Yes, there will be some dissents, but I think if you look at the statements from the very influential members of the committees so far after the last Fed meeting, I think there is a case for a rate cut, and also the inflation number so far has not seen any major influence from the tariffs that we have observed, in the last few months. Although we don't have update on the October and November inflation, so I think they will be in line with what the market is expecting. But my focus will be on what's going to happen going forward. Now, as many as 5 of the 12 voting members of the Fed Policy Committee meeting and 10 of all the 19 members have signaled public interviews that they don't strong case to cut also. So that means, they are going to be very cautious about future guidance. And that is where Powell's press conference is going to be very important. Bond market is, of course, positioning itself for shallow rate cut also, in the sense that, after December, it's going to be uncertain. So we already seen the yields jump along with other reasons for the same. Now, last Fed's summary of economic projections also showed that there will be two rate cuts in 2020, which did happen. October and December probably will happen, and one each in 26 and 27. Now, market earlier was discounting two in 26. That also may come down to one. So that is the situation. Of course, why there is caution about is because while inflation has not jumped, it has also not come down, and the growth has been holding up so far. So there have been some weak data, but not really a slump in the growth that we have seen. So these are the reasons behind for the Fed to be cautious about the future rate cuts. But according to one investment banker, Fed will announce that they'll start buying large quantities of treasury bills in January to maintain ample reserves in the banking system. But this should not be treated as a QE because it's not a long-term, purchases, but it will be meant to maintain certain amount of liquidity in the system, also for pushing up the inflation. So this is one thing that there's a strong market view on this as well. Yes, the focus will be on dot plot, and also the projections for growth and unemployment. It's difficult to envision how officials will be plotting into the future when they really have to, we don't really have much to base their assessments with the lack of official data. But that is the reality, that they have to, make their own assessment, and based on their own research, they will have to go ahead with it. Now, while we are all focusing on Fed today, in order, it's a very crucial event just before the year end. We also have the Japanese central bank meeting next week. They say statements from Ueda yesterday also indicated that the possibility of food inflation going up and yen weakness could be altering the inflation expectations overall. And the statements about currencies also came from as high as Japanese PM yesterday. He said that important for she said important for currencies to move in stable manner, reflecting the fundamentals. But surprisingly, even after such a statement, dollar yen actually went to almost 157, which was trading below 156. So there's something very interesting happening there now. Whether based on the currency weakness, uh, instead of intervention, they will resort to a rate cut because, rate hike. And that is something that will be watched by the market next week. Now, staying on the monetary policy itself, yesterday we also had the Reserve Bank of Australia holding its policy rate unchanged at 3.6%. But kind of a hawkish statement that it accompanied is notable. While the Reserve Bank governor said they did not explicitly consider a case for rate hike at yesterday's meeting, they say that it looks like more rate cuts are not needed. Outlook shows that there could be a pause or hike, and but they don't put a high probability on that as of now. But yes, as I shared yesterday also, most of the central banks are nearing their easing cycle bottom, and ECB definitely no, because even one of the influential ECB member also said about next move by the ECB being a hike. So we are entering into that period of hawkishness. And of course, if you can see the market, bond yields have moved up now from their lows. US yields have on the 10-year have moved up almost 22 to 23 basis points and staying closer to the highs. Uh, we don't ignore that Japanese yields have gone up substantially in this year, while we had only one rate cut of 0.25%. There can be some open market operation by Bank of Japan, but it does look like the way market is behaving, ignoring PM statement about currency, and also the way yields have gone up despite uh, you know nothing happening on the rates. I think is going to be some sort of a market turmoil that we can expect in the year 2026, as we see also fiscal profligacy in many countries, which will be impacting. Where all this is happening, we have had the inflation number from China, while the year-on-year inflation was as expected at 0.7%. Month-on-month, again, slipping into a deflationary territory. It was minus 0.1% versus 0.2% that was expected positive. PPI also fell more than expected at minus 2.2% versus minus 2% expected. So maybe I think that's a one standout odd man out in the global monetary space. China could, continue with its monetary supportive measures. That's one thing that notable. Yesterday's move mostly slightly dollar strength, but nothing major excepting on the yen, and yen of course is on a different footing right now. Uh, Data side, we saw Jolt's data showing higher than expected job openings, but again this possibility that this some methodology changes were there in view of the shutdown that we have seen, so the reliability of the number could be slightly under question. We had seen trade surplus in China widen. That was followed by Germany's trade surplus, which has also widened. Now countries are now managing to hold on to their trades by diversification, although all the countries are seeing lower exports to the US. Dollar, I think dollar will bide its time, feel till FOMC. And normally, until the meeting is over, we do see a range trading, but the final move, whatever happens to the dollar in this month, will be post FOMC, and after that, the market can go to a slumber, although the Bank of Japan meeting around that also could see some more volatility. Speaking of volatility, rupee, of course, which has seen perhaps one of the significant volatile period in this year, is now somewhat steadying around 90 levels. 90-30 has been defining kind of near-term top, not necessarily with the central bank, but even we're seeing some inflows also coming in. Some QIP inflows and exporter selling is also heard. Yesterday there was a news that US is taking note of high export of rice from India and calling it as dumping. But yes, the president also said that he will see what to do about it. He did not spell out any measure, but he did say that he will consider what measure to against that. But I think rupee and overall export view is not so much perturbed by this factor. So rupee has been slightly range. Yes, I don't think we see dollar moving down much against the rupee immediately, particularly when FOMC is ahead. We are purely now seeing what happens to the flows, and with the improvement in the flows, it will be very interesting to see whether the RBI lets it slip or not. So that's one thing that market has been looking forward to, because the most of the weakness in the rupee also came because whenever there was a flow and rupee tended to strengthen, the central bank has stepped in to replenish their reserves. So that's one policy that we are going to watch very closely in the coming months, of course. Yeah, thank you.
Thank you, Dick. And FOMC to watch out for. The rate cut is expected, but the future rate path, that's quite uncertain, as priced by bond markets as well. So we'll see how all of that goes. Powell's presser will be very important in this manner. Apart from that, a few other events. Reserve Bank of Australia kept rates unchanged. Interestingly, the hawkish statement over here is that no more rate cuts are needed. So even RBA seems to be at the end of the easing cycle. We are seeing ECB also. So that's a theme which is emerging, that major developed markets are ending on the easing cycle. Inflation number from China year on year was at 0.7%, but month-on-month numbers showed the deflationary picture. When it comes to our domestic markets, rupee saw some strength, steady around 90 levels against USD as of this time, in a very range-bound action. That's it from Australia. Thanks for listening. We'll catch up tomorrow with a fresh round of updates.